Family syndication, let's start there. I know some of this may be redundant for everybody, but what is a syndication? A syndication at its core is really just a manner of owning. You know, you can own tenancy in common, you can own directly, you can own in partnership, you can have a syndication. A lot of people understand that to mean GP-LP. There's actually a lot of ways to do syndications, but really it just comes down to being a method of ownership. And how do they, the people that are putting the syndication together, earn a piece of the pie? Because we're going to get into that. And it's value add. Hopefully it's not, this is what I would call a deeper value add. But you know, when it works out the way it's supposed to, they deserve the cut that they get because they're doing a lot of hard work in the same fashion that we are, except you know, they have to get the value add to get the numbers, but those are some good opportunities at times. Let's talk about the pros. Hopefully everybody knows who this guy is. Diversification. Because you're not putting as much capital in any particular deal, you're diversifying, but you need to be careful of diversification, not only at the property level, but also at the sponsor level, both of which are important. Lower entry hurdles. We all the time get people asking, what should I do if I have 50,000? Kind of depends on what your trajectory is, but I wouldn't suggest commercial real estate as the first step. I think owning REITs, I think owning syndication, I think there are various stocks and bonds that can work well. As Jason said earlier, we believe in investing. Economies of scale. So all these roofs being in the same color reminds me of Medellin, Colombia, but this is actually just a subdivision, and there's cons to both CRE and to multifamily syndication. Less control. What does less control mean? You don't decide when the property is refinanced. You don't decide whether, if there is a prepayment penalty, it's negotiated. I'm not saying that you would do it any better than they would. It's just that someone who's been through 3 entrepreneurial cold launches and sales values being at least enough in control, not spiritually, but at least enough in control where I feel like I can mitigate some of the risks along the way. And wisdom is not earned any other way than through time. So, you know, what people are often paying for is the mistakes that you've made. You know, this goes into less flexibility. We'll get into some tax flexibilities in addition to the financing flexibilities. Longer hold periods. So when you commit to a syndication, and I've put $750,000 in syndications, you just don't know when your money is going to come out. You know, but if you can become an expert at it and know when it's coming out and have plans for it and keep it in circulation, you know, hats off to you. There is some tax implications to that, depending on the relationships that you form. Fees. It's easy for us as a CRE firm that only charges one time to talk about a business model that charges more than one time. But I actually have nothing truly bad to say about it, other than the fact you'll pay for them to help buy, refinance, sell, manage the asset, sometimes the property management, sometimes the leasing. In many instances, you're going to pay somebody. But you know, you are paying a number of fees, and the fees are fine, profit sharing is fine, and they're fine in combination. Just some people don't understand syndications at this level, and it's okay that they get a piece of the pie. Now, this particular piece of the pie looks like 25%. I'd say the average is more like 30%. There's a variety of structures. Some are tiered, and they get a higher return when they go over the high water mark. I do think sometimes it gets a little obnoxious, but I tell you what, if I ever invest in a syndication and they go over their high water mark and they're into the higher profit splits, I personally will have no complaints. Less lease protection. So somebody asked a question earlier and I think I answered to the group. Are you afraid of a long-term lease? Because these are shorter term leases. Are you afraid of longer term leases as a function of inflation? And we had a whole nother webinar on this, but this particular dog didn't always stick his tongue out, but gross leases are not inflation protected. So whether you think of those in the multifamily or commercial sense, it's called a full service lease. So everybody's always going to pay for what they incur inside their space, so their utilities, et cetera. But in terms of paying for elevator service or air conditioning the hallway, that is passed back to the landlord. So inflation, while it drives rents, it also drives the costs back to the landlord. And I think people like analogies. I didn't want to use a boat. There's gross, modified gross, net, double net, triple net, absolute net. I didn't want to get into all that tonight, but I wanted to pick a boat that I thought was worthy of just investing, period. So if and I don't know why it says Unsplash Plus because I am a member, but this is what I would call a gross lease if it were a boat. So 1031 exchanges, the exchange. A lot of people aren't aware of this. Some people think there's no problem doing 1031 exchanges in a syndication. Others think that you can't do it, and both are actually incorrect. You can 1031 exchange 1031 investment, but when they say like kind, they do mean like kind. So you need to not only exchange in a syndication, but it needs to be with the same sponsor. And so you just need to be aware that you will need to choose the same sponsor, and the sponsor has to have an opportunity in the time window that you're looking for to take advantage of 1031. And I oftentimes skip over things. So I'm going to try to say 1031, let's say you buy a property, you depreciate it, and let's just even say you sell it at the price you paid for it. You have to recapture that depreciation and pay tax on it, unless you 1031 it, in which case you roll that permanently until you take, and then you get the step up in basis. Back to the same pros, stable income. And you think about it, the average term of lease means that you have more maintenance and turnover. And for us, we really like apartments. It's just with what's known as cap rate compression where it is, we thought that the cost of debt reset was too large of a risk. So presently we steer clear. We still look at a lot of deals. We've just turned them all down. So again, long leases, absolute net. This was a slide from a prior video, so I don't want to bore everybody, but absolute net, like when you go from gross, which is full service, to absolute net, you're going from basic to premium. So absolute net is they're going to take care of the roof, the parking lot, maintenance, repairs, common area, parking lots. So it's if it's done correctly, I'm not going to say it's not without its own risks, because it is, but that's what an absolute net lease is. And to keep the theme common, if the other boat was a gross lease, then I'm sure there's better boats, but this one has a helicopter on it. So this is the absolute net lease version. Because of the structure of the lease, you have lower maintenance concerns. It's one thing for it to be costly. It's another thing for it to cost your time. I personally am at the point where it's not just about the maintenance, it's about what it's going to distract me from doing that I could be doing otherwise, whether that's making money or whether it's spending time with people that I love and care about. There's less management, obviously. Now, people often ask the question, who manages your properties? You guys manage them? we always interview and engage third-party management companies, and we include the client in making those decisions. Stronger credit tenants. I don't know that they're stronger than these four ladies who look like they're crossfitting. But if you think about it, any one individual is not as strong as a company that's profitable. And the companies will often credit guarantee the leases. And so that's why we say stronger credit tenants. It's also an inflation hedge, to the person's point on 2% inflation. We've shown this. You guys have probably seen it, or many of you have. If you haven't, it's probably one of the most important investment charts ever. There's two basic investment choices: cash and anything else. And the most certain way to lose money is to invest in cash. Over 100 years, you'll lose because of the printing press. So yeah, you hope the rent escalators are as high as possible, but that is a benefit as well. Typically, those are negotiated as the turns happen on multifamily. And then again, we talked about the differences in 1031 exchanges. Cons, there's higher entry costs. There's higher entry costs to being more successful. There's higher entry costs to buying commercial real estate, for sure. So why do investors who choose to invest directly in CRE make that decision? More stability. I have no idea how this rock is still standing, but more stability. Same things we've covered previously: less management of people, of property managers. I will say this: stronger credit tenants, stronger managers. The manager experience, at least for me in single family versus commercial, has been completely different. More control. And then as a function of being able to do your own cost segregations and maximize your tax deductions, there's more tax efficiency. Is a stabilized property a Lamborghini? I don't know. I happen to love the brand. I think they treat their customers very well. But stabilized means it pays cash on year one. And the one thing people don't realize on the value add is sometimes they hear the pref return, and maybe sometimes not. Hey, it's 6, it's 8, whatever it is. They have to do the value add to get there. So, to expect 1, 2, 3% or 2, 3, 4%, and then hopefully, subject to the interest rate environment, you're going to be able to refinance some of your money out. Everybody knows what the BRRRR strategy is: buy, rehab, rent, repeat. That is designed for a certain interest rate environment. And most people don't know what a cash in refinance is. They know what a cash out refinance is. So with our stabilized properties, I can't say which is necessarily risky, but they're already paying. So there's nothing to change or do. I will ask, does anybody have any questions and answers? I try to go fast without skipping over too much. Jason, I don't know if you want to field the questions, if you want me to field the questions.